We have a saying around here that what sustainability is all about is 4 billion new people wanting to eat chicken and drive a car. What we're talking about here are massive, gross demographic shifts. It embodies all the things about youth. It embodies all the things about the emerging middle class. And it also embodies a sense of almost unstoppable trajectory. You know, whenever I get into a discussion with folks that want to make this into a political issue, especially here in the U.S., you know, it's this sort of progressive thinking about sustainability and being green. I tell them that, you know, when you become middle class, and middle class in emerging countries, in developing countries, happens at an unbelievably low hurdle rate. In general, McKinsey did a tremendous amount of work in the 1990s that really showed, in the 2000s, that showed that the buying power to be considered sort of the emerging middle class in developing countries came as low as $2,500 a year to $3,500 a year. That's when the first cell phones are bought, the first transportation is bought, the consumption of power and electricity. And so we're really faced with a massive global demographics. You know, I joke that the 1980s and 1990s were about the information age, and that the 2000s were all about sort of global mobility and connectivity and the internet. Our belief is that the next couple of decades are all about basic needs 3.0. You know, sort of the return of Maslow's hierarchy of needs as an investment fundamental thesis, whether it's about risk management or value creation.
Let's start with risk. How do you think about risk in the environment you just laid out?
I think, again, just to touch on that on a couple of notes, I think one of the most interesting things that's happened within the last 12 to 18 months, and I think almost every one of our panelists has seen this, is that the issue of sustainability and what I've just talked about, and whether it's climate change as a component of that, whether it's natural resource constraint, whether it's demographic shift and growth, I think increasingly investors, and from our visibility, it's mostly institutional investors, they now see this not in terms of values and responsibility and obligation. They now see it actually in pretty raw economic terms. They're seeing a shift in the economics. They're seeing the value that's created and the risk that's created in these shifts. Just in fact, you know, a small example of that. Just before Hurricane Sandy hit the shores, Munich Re. And again, not a company that would be sort of at the leading edge of innovative thinking and risk, published a report literally a week before Sandy that statistically showed that from their perspective as a reinsurer, that you had a 5x increase in the amount of extreme weather that was hitting this country. And they interpreted that in terms of, again, value and risk management. And so increasingly we're seeing this kind of dialogue, whether it's pension plans, sovereign wealth funds, endowments, foundations, increasingly turning to this kind of vocabulary, the risk and the value of that. In terms of your question about risk-adjusted reward, I think one of the greatest things that actually happened as a result of the great meltdown of 2007, 2008 is that you know, investors in some ways glibly talked about returns in the sort of 12+%. Everything is 12+%. Everything, you know, if I want to manage my portfolio, and I'm being a little facetious here, but one of the things that happened with the great meltdown is that over the last 5 years, we have been in a situation where we've seen the decompression of returns. In other words, there are a bunch of things that aren't returning very well. And so this glib notion that everything is a 12% returner has really compressed back to the basics that we were supposed to learn in finance, which is what's the risk and what's the appropriate reward, the return model for that risk. We're watching portfolio managers get back to resegmenting their portfolios based on no risk, mid risk, and high risk, and look at their job as purchasing risk. In some ways, this has been just tremendous for this conversation, because a lot of the things that we're talking about here within sustainability map to very distinct categories of risk, and now we have a market that accepts that these risk categories have very different returns models.
But you also have some interesting thinking about how to think about returns in this coming context.
Yeah, and I think that if we start talking about big ideas, I'll put one that's in some ways it will feel very theoretical, but I think that it's going to be something that I think will launch into a series of I think academic research over the next few years, and we're starting to see vestiges of that. And that is, and Lloyd, I think you'd really appreciate this. We've spent the last couple of decades along the markets of derivatives and securitization, arguably things that helped catalyze the great downturn of 2007. And that has been all about the compartmentalization of risk in any category, and then the appropriate pricing of that risk, and then the sale of that particular risk category to an appropriate investor. And so that's now become a very finely honed set of art forms, whether you like them or not, or agree with them or not. And for our audience, this is commonly referred to as the tranching of risk. And this was when the art form that allowed us to turn subprime mortgage portfolios into a low risk, mid risk, high risk from very high risk portfolios. Mm-hmm. And there's been a tremendous amount of academic work that was supporting how you go about doing that. I think that over the course of the next decade, we're going to do the flip side of that, and we're going to be asking within a benefit or a returns model, how do you tranche the returns model so that there's a slice of the returns model which is very much focused on environmental, focused on community and society, and focused on monetary returns. And I think we're going to start asking how we price those, how we then sell each of those slices differently to investor classes that may want to buy a different form of benefit or return other than just money. And how you take an attribute like what, for example, Adam is doing, which is in the environmental services area, and rethink the repackaging of the benefits to the appropriate investor. I think it's also going to do something, which is it's going to force what has historically been a fuzzy field that we're all talking about, which is impact or societal and environmental benefit, and actually turn it increasingly into a quantifiable art form or instrument. One of this panelist earlier spoke about social impact bonds. And one of the attributes and outcomes of social impact bonds is exactly that. It turns a soft attribute or a soft benefit into a very, very quantifiable benefit that has tremendous power, but it also has tremendous opportunities that threaten the status quo. So none of these ideas are going to be simple to implement because they do change, as Joy talked about, the way the rules have been set, and we're going to have to reset the rules.
What about this abundance of capital? That blows people's minds when they come out of the nonprofit world or the philanthropic world, that somehow there's a lot of money when in fact their whole life has been under the experience of not nearly enough money. And what happens when you flip that frame and you think about the abundance of capital?
Yeah, I think you're asking two separate questions there, and I think it's well worth unpacking that. In terms of abundance of capital, sort of in the fun facts and figures realm, if you take the top 5 U.S. companies from a market cap standpoint, and that would include Apple, it would include folks like Google, folks like Exxon, you have $350 billion right now sitting on their balance sheet. That's a lot of capital. If you take a look at the signatories of the UNPRI, Principles of Responsible Investing, literally now we're talking about trillions and trillions of dollars that are supposedly focused on these sets of topics. The key issue, though, is treating that pool of capital and those pools of capital as investors and speaking in dialogue and the language that's appropriate to them. But just to give you, I think, a little optimism, when things are translated into economic terms, capital can move, and in our modern capital system, it can move at a surprisingly fast clip. So, one of the things that I think is often overlooked here in the United States is that We've got about 28 states or so that have renewable portfolio standards. And for those of you that may or may not be familiar with that, that's a set of laws that were passed in the last 10 years that mandated that power generation in those states that carry those RPS laws had anywhere between 15 to 25% of their power generation coming from renewable resources. And when those laws were passed 10 years ago, these numbers, 15 to 25% of energy generation, and that sounded like a daunting number. I think the surprising statistic that shocks people is that 21 out of those states have already hit their mandated 15 or 25%. So think about that. Within a 10-year period of time, and you can do the math, all right, in terms of the number of dollars that have been deployed. I mean, quite literally, we're talking about somewhere in the order of about $100 billion that's been deployed. Actually, that number probably understates it. It's probably much closer to $200-300 billion that's been deployed in RPS mandates over the last few years, and it shocks people to know that 21 of our states now have met RPS. All right. I'll give you another bad example, and it's not one that we're particularly fond of, but just to show you how fast capital can move. All right, so environmentalists have been rallying against the coal industry now for what, 20, 30, 40 years, and intensely over the last 10, 15 years. Our natural gas deposits, now granted that's coming out of a lot of the fracking that's going on, but natural gas has basically brought coal to its knees, and it's done it in the last 5 years. So you now actually have utilities. I mean, when was the last time you saw a clean coal commercial? Part of it is because no one's listening. So the whole point here is we now have utilities that are unplugging their coal-fired facilities and converting them over to natural gas. You know, and so just again, if the economics are aligned, the incentives are aligned, the language is aligned, the numbers are aligned, the capital markets can move at a blindingly fast speed. And we've got those two examples just sitting in front of us of how fast advocacy can work versus using economics in the capital markets. Now that has threats and it has downsides. It has all sorts of potential for abuse. But the speed and power is absolutely there.